Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cents segment. I'm Pete Wargent and I'm here with the Blusk founder, Chris Bates. How are you, Chris?
Pete, happy Merry Christmas, New Year, I guess. We're recording this on Thursday, but I can see you getting in the Christmas spirit here. Good effort.
Not through choice. The kids kind of made me do this, but that's my excuse and I'm sticking to it. But get into the festive season. So, yes, this will actually probably go out just after Christmas, but we're recording just before. And, it's been a busy week or two trying to get everything ready, but almost everyone's in wind-down mode now as we record this. So what have you been up to this week?
Yeah, it's interesting. We're still getting quite a few purchases, even right up to Christmas. I think we sort of thought that might happen, that the agents would go hard all the way up till Christmas, and then they'd finally switch off by Friday this week. So, yeah, we've had quite a few clients buy this week, which, to be honest, was expected because people are a little bit nervous that they don't really want to stay off the market for another couple of months. And low listings are really starting to dry up. And even some of the poorer properties we're finding are now starting to shift, which is a sign of still strength in the market, even though, rates are where they are. So it's been such a funny year, 2023. The opposite of what people thought would happen happened. And, even the same as 2022 and 2021. So I think next year, a lot of the forecast of what people think is going to happen in 2024, which we're going to talk about now, is that potentially going to be wrong as well. Maybe that the market's going to be much stronger than people expect.
Oh, there's been a massive rally in the bond market. It's, I think if you went back to early October and then there was, a new geopolitical shock and everyone was like, oh no, here we go again. Oil prices are going to shoot up. But actually we haven't seen that. I think oil production's been very high in the US, like a quiet boom in production, and I think demand has fallen away as well around the world with all the interest rate hikes, and inflation is just plummeting. The UK inflation rate just reported today just dropped all the way down to 3.9%. It wasn't long ago it was at 11. It's absolutely plummeting, and Eurozone's down to 2.4, US and Canada down to 3. So Australia's got a bit of a way to go on that journey, but you can see from what markets are pricing, I guess the expectation is we're going to follow in the same vein, I guess. We're definitely going to see lower petrol prices over the next little period, which is always a good thing for confidence. And I guess in the space of 2 or 3 months, we've seen a huge shift. If you look at 10-year bond yields, I think you looked them up just before we came on air. I think, I guess, you would know better than me. I know the 3-year bond yield in Australia, the government bond yield, is down from about 4.4% to, 3.66 as we record this today. It's a massive shift, and that's a key funding benchmark for the housing market and mortgages. So, yeah, and if you look 18 months out, we're probably pricing in a few cuts now, which even a month or two ago just wasn't the case.
Yeah, absolutely. I think if that trajectory continues, the ASX rate tracker as well, which I always like to look on, it's been a pretty flat line, maybe one more increase, but no rate cuts for some time. But, just having a quick squiz at it this morning, they're expecting at 3, potentially, maybe 4 rate cuts over the next, 12 to 18 months. And I think as soon as people feeling they get the first rate cut, there'll be this expectation that are more to come, and that'll give people, much greater confidence to kind of stretch their budgets. I think a lot of people are stretching their budgets now because that's all they can borrow. But for the spare capacity in their market, where people have got heaps of capacity, but they're not sure whether they want to stretch, I think that's going to come into the market. And that FOMO can really kick off, particularly if this expectation starts to get even stronger that rate cuts are coming.
It's not a bad little tool, though. We put a link in the show notes there for you, just to show what they call the implied yield curve. So I think one of the things we should have probably learned over the past couple of years, that there's always talking heads in the media saying, well, this is going to happen and that's going to happen. But very often the safest or most reliable place to go is just to look at what markets are pricing, because they're usually pretty efficient. Not always, but usually. And if you look what the implications are, the implied yields over the next 18 months. Well, they're now expected to come down. I think if you went back a few months ago, people were still thinking, well, maybe we're going to get another hike or maybe 2 more hikes. But yeah, I mean, I think the next inflation figures for Australia are out on the 31st of January. And that will basically be the key deciding factor whether we're done for this cycle. I think if it's 1% or less, then you can forget further hikes for the quarter. So that'll be watched very closely. I think if it's 1.1 or 1.2, well, there'll be some debate about whether they need to do one more. But yeah, definitely a useful tool if you don't follow this all that closely. So we'll put a link in the show notes there. It's updated every work day, not every trading day. And you can just see what markets are expecting for the cash rate in Australia over the next year. It's quite useful if you're just managing your cash flows or trying to get a feel for what might happen over the year or next 18 months.
Yeah, I think when you look at it, you expand the 3-year Australian bond yield out over, 5-10 years, you can see it's not that volatile, really. There's some times where there's a big adjustment, i.e., coming into COVID, the bond yield started to really drop, negative interest rates around the world, etc. And then there was a period in COVID where it was just very, very low, and then bang, it just shot up. And then in the last 12, 18 months, it's been very, very volatile. It's, no one really knows how this is going to play out. And so the rate story has shifted many times. And so it's showing really positive signs. We could still be surprised and it could do another jump back up. But, I think a lot of those unknowns are starting to get known with inflation, and that's giving the market much more confidence. So it's going to be interesting to see if that yield just continues to drop dramatically back to, what it was maybe 12, 18 months ago, or even what it could have been back in COVID times if inflation and growth really slows down. So what are the 3 stories we're going to cover this week, Pete?
It's been a pretty decent learning curve, hasn't it, over the past few years? All these things that nobody ever put in the textbooks. So what happens with negative interest rates and negative bond yields? Those are not things that were ever talked about in the economics textbooks. And I guess you would think, well, some crazy things will happen, and they did. But also, who really knew that the economy could just be locked down, and borders can be shut, and then people can be put on furlough schemes and JobKeeper and all this kind of stuff. It's been an absolutely wild few years. Yeah. And I was actually just chatting to Michael Yardney the other day, and we were thinking it wasn't so long ago. They were talking about the US unemployment rate might hit 25%. And here we are today at under 4%. It's absolutely crazy how things have gone. And I guess all things considered, yeah, we've taken some pain on interest rates, but considering what might have happened, we've been pretty lucky, as Australia often is. Big 3 news stories of the week. So firstly, working from home remains popular. Latest ABS figures showed that more people are back in the office, but we're still not back to the pre-pandemic level. So we'll take a bit of a look at that and what's happening. Secondly, a macro business article, Aussie housing market is impacting the retirement system. So more people are taking debt into retirement, and also more people are renting in retirement. So that's going to have a bit of a shift in terms of what home ownership rates actually mean for the retirement system. And then thirdly, we're just going to take a bit of a look at the outlook for 2024. Proptrack put out some generally quite optimistic forecasts, but actually, as we just touched on before, even since a lot of these reports were pieced together, there's been a massive shift in bond markets. The Federal Reserve in the US has just gone for a full pivot. The conversation has gone from do we need to hike interest rates to how much are we going to cut next year. Markets are pricing 5 or 6 cuts for the US, for the UK, maybe not quite so much for Australia, but the whole conversation has shifted in the past month or two. So we'll take a look at the outlook as well. So Chris, first story, ABS working from home. So down from the peak, but still above pre-pandemic levels. So I guess the figures only go up to August. 37% of Australians regularly still working from home. In 2021, a couple of years earlier, we were 5 percentage points above the pre-pandemic level, which was about 32%. So we basically went from 32% to 40%, and now we're back to 37%. So it's trending lower, but what the stats seem to show is a lot of people are doing 3 days in the office and not 5, and in particular, managers and professionals. So that tug of war dynamic that we've talked about before is still going on. And I guess that for the time being anyway, with the unemployment rate under 4%, the balance of power is still very much with the employees and not with the employer.
Yeah, I mean, I always like to look on the AFR, and they, have a whole section from working from home. It's just such a big topic. The headlines are, first in the queue in redundancies are people who work from home. Cuts. You're not going to get your full bonus if you work from home, and so, and I think there's the argument. You've got some very pro hybrid, and then you've got some people, we're getting productivity if you get it back into the office. So this conversation is going to keep playing out. I would say, however, just looking at the general consensus, talking to our clients who, comparing that to, say, 2020, 2021, people are very nervous going too far away from the capital city right now. Now, that's, I think, because they believe that they don't want to switch jobs. They have to go back to the city because they've been surprised. They thought they could maybe work from home 4 or 5 days a week. However, they've been told they have to get back to the office 3 days a week. And that's shifting. So even if they didn't move and they were renting, they've been surprised how much they have to go back to the office. They're also wanting to go back to the office. I think the city's got its mojo back. People are wanting to be around people. Partners are wanting to catch up face-to-face rather than Zoom. And I think people are realizing that there is a bit of a benefit being in the city. And so I think however, I do think when people can't afford a housing solution and they're renting and they do need they'll have to make some lifestyle changes. And part of that will be moving away again. And so I think the commutable locations outside the city are not a bad time to be buying, to be honest, because the demand isn't there as strong because of this conversation. However, if you believe in that hybrid work's here to stay, which is, would be a pretty good bet, I reckon, then I think these commutable locations are sort of a bit of counter-cyclical versus trying to buy around the city right now, which is very hard.
Indeed, yeah. So the ABS said that although working from home has persisted, most of the other arrangements like flexible working hours haven't really changed since the pre-pandemic trends. So it's only really that working from home that's persisted. People haven't shifted to more flexible hours or flexible working conditions. You talked about counter-cyclical or contrarian moves. What about this? I was in London last week, and the Square Mile, there is construction going on like you wouldn't believe. There's the City of London Corp has approved 10 new office towers, just, bang, 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 and all of them are going to exceed all of the height of the existing tower block. So there's 5 million square feet of office space under construction, reported the New York Times, with another 5 million square feet in the pipeline. It's absolutely teeing off. So this is an enormous bet by developers on the return to the office, which I was really surprised about because, even a year ago, people were saying, well, nobody's going to come back into the office. This is a permanent change. But well, there's some big dollars or big pounds, I should say, being thrown into the Square Mile in London, which, if you're not familiar, is the business district around close to the Bank of England and that kind of area. And historically, they didn't have sort of loads of tall office buildings in the Square Mile, but now they've just really gone for it, and there's 10 been approved. So very interesting because there have been other business districts like the Canary Wharf and Docklands area, but a massive bet on the return to the Square Mile. So I don't know whether Australia will follow suit. What do you reckon?
Well, we've still got some pretty strong developments underway in our capital cities, and so the pipeline for high, AAA grade or A grade sort of commercial assets is really strong. And I think that's what employers are saying. Look, if we're going to get people back to the office, we've got to have a sexy office. It's got to be in a great location. And it's got to be really enticing. We can't just, expect people to come to our, our B, C grade building with no aircon that, is actually nicer to be working from home. And so I think people are saying, well, we'll have less space, but we'll have much better quality space. And that'll be part of our talent draw card is that you do have flexible work, but when you do want to come to work, you get to work in this, nice, sexy space. You think about places like North Sydney. I think your vacancy rates are close to 20%. I haven't checked that recently, but it's enormous. But go try to rent in one of the best buildings there. I think it's still pretty tough, and they can still charge huge square meter rates, particularly if it's around this new metro line. So, yeah, I think it's just a changing of a guard. And I think, but there is a moving to residential within our capital. We had these commercial zones and there wasn't much resi in there. But I think that we're getting a nice mix now where there's residential mixed with commercial, and that makes it even more lively on weekends and, out of office hours. And So I think that'll bring the city back as well.
It's one of the paradoxes, I think, of an oversupply, that it can really improve the quality of the stock. If you think back to certainly in Brisbane, if you went back 6 or 7 years ago, and there was all the overbuilding, there was so many new apartments, but it had an interesting knock-on effect that where previously people had been able to rent out really crappy old Queenslanders with no work done on them, the post-war type of home, 3-bed, 1-bath, and, live termites and all of that stuff. Well, that stuff just wasn't renting, and people were forced to either sell or just improve the quality of the rental stock. So, eventually, rents fall and then people move into the areas that have got cheaper. So it kind of rights itself eventually. But the knock-on impact of the overbuilding or the oversupply is that it can improve the quality of the stock. And I think exactly as you talk about there, some of those B-grade offices where people were rammed in like battery cages and or some of the tired or old stock, well, that's just not going to get filled. So people will be forced to either improve it or convert it, or there's going to be long periods of vacancies until the rents come down to a more sustainable level. So it's not always bad when you get these oversupply issues. It can be bad if you're the bag holder, but actually for the market overall, it tends to sort itself out over time.
Yeah, so I think this 2024 story is absolutely going to be this battle, this tug of war between employers, employees. Where does the unemployment rate go to? How confident are people with their consumer confidence and how they're confident about their future work prospects and income growth, etc. All this links in very tightly to the housing market and the sentiment behind it. So if that become even more positive, people are less concerned about losing their job. They're more confident about wage increases, and the unemployment, seems like it's got a bit of a cap on it. Then, I think people will go out and, particularly if they need to, will go and look to invest that into housing. And so, however, if it goes the other way, then obviously that will slow down demand, but I think it also slows down supply. I think people really need to understand that, the listings and how many people are selling, that turnover rate really affects, the market. And I think we've seen that more than ever in the last 2 or 3 years. So let's watch this story all next year, Pete, because it is an interesting one. So what's number 2, mate?
I was interested to see a couple of big build-to-rent developments just breaking ground over the past week or two. Melbourne Quarter, Flinders Street, some big build-to-rent tower blocks. They might sort of bring 800 units or so to the market. They'll be 3 years away before they actually come to market. But those are, it's been a really difficult time for developers. So interesting to see a couple of those getting out of the ground. Second story, Aussie housing market impacting the retirement system, macro business article. If the home ownership rate falls, then there's significant impacts for the retirement system in Australia. More people over the age of 55 are now renting proportionally, and the trend is generally up over time. I think some of the other stats they've highlighted from Tarek Brooker and a couple of other sources like Grattan Institute, more retirees are taking debt into retirement, which I guess in some cases might be smart, and we might see an increase in reverse mortgages. But I guess, yes, if more people are renting in retirement and more people are taking debt into retirement, well, that's going to have an equivalent knock-on impact to the success or otherwise of the retirement system. So any trends that you're seeing there, Chris?
I think reverse mortgages are absolutely. I think people are going to go into retirement with more debt. They're going to upgrade later. So they're going to, upgrade to that teenager sort of family forever home later. And they're going to go in there with more debt than they can probably afford. And there's going to be, conflicting, options, save for retirement, enjoy life now with kids and when they've got their grandkids and, maybe they retire a bit later, etc. But I think absolutely people are going to carry debt into retirement rather than that dream of having the house paid off. I just think that's the evolution of our housing market. And people are going to be forced to downsize because they won't be able to hold that debt in retirement. Rather than before, they could sit in their house and, even if they wanted to downsize, they didn't have to, right? So it's probably not a bad thing in the future that people are going to have to downsize, because I don't think right now they do. This is one of the things that's free. When you think about spare bedrooms, right? The capacity of our, how many bedrooms in Australia versus how many people, we're probably okay. It's just that there's lots of people living in 3, 4, 5, 6-bedroom houses. There's only 2 people living in them because their house has been growing tax-free. The grandkids come a couple of times a year and, it's an amazing asset and all their friends, and they can't find something else they'd rather downsize to. So, and I think reverse mortgages is also going to stop them downsizing, because even if they do get, tight with their cash flow, their super balance runs down, or they want to help their kids, there's lots of innovation in this space happening. Brian Hartzer, they've just rebranded. It used to be a company called To Be. I can't remember exactly what they've rebranded to, but that's an innovation around sort of a reverse mortgage. The government had a reverse mortgage scheme, which, is a bit counterintuitive, a lot of things they do. Unintended consequences of that. So, reverse mortgages are actually going to freeze up housing stock more and more. So if you can't draw down on your mortgage, then you have to sell. Then that allows that home to come on the market for the younger generation. However, and people don't want to go to aged care homes, right? So, we've just had a Royal Commission, into that. So you can see there's obviously some issues there as well. So, the whole taking debt into retirement, to me, I just think that's the evolution of the housing market becoming more and more expensive. Like longer term loans are going to be the evolution. We'll have 40-year loans, I imagine, in the next 5 or 10 years. And the other thing is that the home ownership rate has been falling. And it's falling across all different decades, I guess, of your life cycle. And if you think about that two ways, that's not great, right? Because less people can afford to buy. But what it also shows is there's a lot of people that would love to buy. That's pent up demand. The 40-year-old with kids would absolutely love to enter the market if they could find a way. And so you can't say that there's not enough demand in the housing market, because as the owner occupier rate falls, that is actually pent up demand. There's all those people who haven't been able to buy would love to buy.
You're right. I think taking debt into retirement is an interesting one. Particularly for an investor. If you've got, say, 20% LVR going into retirement, well, why not? A lot of businesses carry a small amount of debt, because it sort of, it gives them capital, but it can actually increase the value of the business if you've got a modest amount of leverage. And it's the same for an investor. You've got a bit of a tax shield. And you don't have to extinguish all of the debt as you go into retirement. I think reverse mortgages, they haven't been that popular in Australia, I think largely because of capital requirements for banks. But I think you'll probably find as financial innovation goes along, as you touched on, then they will become more popular. It would kind of make sense, you would think. On the home ownership point, the Grattan Institute has done a nice little graph which shows that at the moment, 76% of people over the age of 65 own a home. But if you actually project out trends, with people buying later, more divorces, more separations, that by 2056, so bear in mind, who really knows what's going to happen over the next 30 plus years, but could decline to say 57%, which changes the whole dynamic of retirement. I think, we used to think of the Australian dream being debt-free, home ownership, and that being sort of the security blanket or the foundation of a comfortable retirement. But if it does drop like that, then that does change the dynamic for a lot of people. But I agree with what you're saying. I think part of the reason there's so much angst actually in the housing market commentary and debate is that actually there's a lot of people who do want to buy and haven't been able to. So, that is actually, it's a pent up demand story, as you said. It's, if everybody was happy renting, there wouldn't be so much of a debate. Remember when I lived in Germany a few years ago now, but a lot of people rented and did so happily, but it's not really the way the market's been set up in Australia. Most people, I guess, as the numbers show, most people aspire to own.
Yeah, and I think all the surveys come out. A few years ago, it was like, Gen Y don't want to buy. And then you do surveys, and I think pretty sure all those surveys show that they do want to buy. There was that rent vesting, I'll rent where I want to live and, invest my money elsewhere. Well, that's okay if renting's really easy and there's no rental crisis and rents aren't going up. And also when you're a single, you're a couple. But as soon as you get to this sort of family stage, and you have to move once with kids, you realize you don't want to try to do that again. And you've got school zones and all sorts of, and so I do think this is it's not just an Australian problem. I was watching a Boris Johnson AFR quick snippet yesterday, actually. It was quite amusing. It was And he was basically saying the same thing in the UK, right? Like, the biggest issue for the younger generation there is that they don't know how to they can't see a way of entering into the property market and getting that security. And that's given them a lot of, stress because the rents over there have gone up a lot as well. So, yeah, I think this is going to be a big story. And I think that's why the YIMBY movement is getting some real steam behind it. I think it's going to be a massive political thing in the budget. And I think this, because, when you've got a rental crisis, a homelessness crisis, and you've got a housing affordability crisis, and you've also got a mortgage affordability crisis right now. So wherever way you look at it, the housing market's a bit of a mess. The only ones that are probably doing all right are the cashed-up baby boomers with their house paid off because they're getting house price growth. They're getting great returns on their cash. Their house is paid off. And then their investment properties are pretty paid off anyway, so they're getting rental increases there. So, it's all about having a good time right now.
Well, that's why they always say demographics are destiny, because I think when we're younger, we tend to think we're all very different. We're going to do our own thing. We're going to travel, do this and the other, which we often do when we're younger. But it's interesting how many people do similar things at similar times in their lives. You see all these trends. I remember when I was 28, 29, that everyone was getting married, like wedding, and then people who've bought a unit decide, well, we're going to have kids, and then, we actually need to trade up. We need a townhouse or a house. And it's interesting how people are probably more similar than different. And yes, you're saying some of those surveys where they say, in the future, kids, the Gen Ys, they're going to be, wearing their virtual reality headsets. So they won't want to buy property. And it's like, that sort of thing. It's like the old surveys that always used to say, music's going to fall out of fashion. It's going to be, the new trends will be yo-yos or Nintendos or whatever. Every single time music comes back as the most popular. And it is a bit the same with home ownership. People actually do want to ultimately aspire to own their own home at some point in the journey very often. So, but some interesting trends there. But, the home ownership rate may well fall as we grow as a country. I think that's fairly inevitable or pretty likely. If we push the population from 27 million to 40, you probably find that the percentage of people owning is actually lower over time.
And I think there's a real pressure right now, which the banks are already jumping on. Was it Rob McNewen from NAB? Shane Elliott at ANZ. A bit of noise in the broker community. It's and CBA have released information around who's borrowing money. And you can very clearly see there's an inequality issue building under this tight borrowing capacity. And it's pushing out first home buyers, particularly on medium and lower incomes. So A, they're already struggling. And then B, their chance of buying, prices have gone up, but their borrowing capacities mean they just can't enter. And so I think that's going to lead to, relaxing in banking standards. Maybe not the way they assess won't get relaxed, but how much they'll lend you will get relaxed. Longer loans, small little tweaks. Maybe APRA will step in. And so I think we'll see a real big jump in borrowing capacity together when rate cuts come. And unfortunately, that will get factored pretty quick into prices. I think people are going to underestimate this trends. I forget the word. It's the wealth transfer, from intergenerational wealth coming down. I've been surprised by this so much. But when you look at the amount of money, equity in the property market, the super system, the shares, where that money is actually sitting, and then where the pain is in the economy is with their kids and their grandkids, and they don't want them to leave the capital city. You can already see them actually starting to pass that money down. Those baby boomers that are doing all right are saying, hang on, here you go, here's some cash. We don't want you to move away with the grandkids. And I think that's going to create a further inequality problem because they're really going to have more ability to outbuy everyone else in the market.
You made a good point there. We've still got this lending assessment buffer in place, 3 percentage points. Now, people might say if you go back through history, there have been periods where interest rates have increased by more than 3 percentage points. But when they do, that means nominal wages are increasing very sharply. And in fact, incomes are going up pretty quickly at the moment. But if you look at where interest rates are expected to be 18 months from now, probably a few cuts sort of lower. And then if you go to the 3-year, potentially all the way down to a neutral setting, maybe 3.5. So why are we still stress testing people for a sort of a mirage there of 3 percentage points? It's the equivalent of 12 rate hikes at a time when markets are expecting the opposite. It doesn't make sense. It's now shutting people out, and it's shutting out first home buyers, sacrificing them on the altar of financial stability, as they say. A friend of mine always used to say that in Melbourne. But also, it's shutting investors out as well at a time when we've got the lowest vacancy rates on record. I saw another shift downwards in Sydney. If you look at Justin Fabo, Antipodes and Macro, just seasonally adjusted rental vacancy rates from the Real Estate Institute, and inner Sydney filling up fast, and we're just not getting the investors come through either. So I know what's happening. Of course, the Council of Financial Regulators are saying, let's keep a foot on the brakes as much as we can until inflation comes back to target. But it is actually shutting people out now, and it's causing major problems. We've got tent cities in some parts of the country. We've got rental vacancies at close to zero in a lot of parts of the country. Construction, we've seen the dwelling completions have fallen from 60,000 a quarter to 40, and this is at a time when the population is absolutely booming. So, yeah, I get it. We need a stress test, but 3 percentage points is too much now.
And I think what we're going to learn over the next decade in the housing market is going to surprise it. I think that this ability to rent a house somewhere near the capital city is going to get really, really, really hard. If an investor owns a house right now and maybe they've held it for 30 years, now they want to give that money down to their grandkids, right? They sell their house in the eastern suburbs of Sydney for 2-3 mil, if not more. They give that money to the kids and the grandkids. But who buys that house is not going to be another investor. So that rental, that's going to go to another home buyer, rather than. So that's one less property for rent in the housing market in our capital city. And I think that's just really going to start playing out. Every house that comes on the market isn't going to get bought by an investor unless it's an investor that's going to knock them down and, combine 4 or 5 houses and build 30 apartments. But that's even worse, that actually takes away 6 or 7 houses out of the rental pool potentially, or the owner-occupier pool. And so, really sort of watch this space. It's going to get harder and harder. You can see rents in the eastern suburbs have gone up 25-30%. So it's $1,800 a week or something stupid for the median house, and other parts of Sydney. So it's hard to rent, not only just hard to buy. And I think that'll even get much harder over the next decade.
Well, those rental vacancy rates are actually now near enough back to where they were in 2007. And I remember at the time, because I was living in the eastern suburbs in Sydney, and just at various social events or work events, people were saying, hang on, my rent's just gone up 40%, just absolutely crazy stuff. And we're not far away from those rental vacancy rates again now. And yeah, last time it was caused by a shock, the global financial crisis. This time a different type of shock, but it's a similar outcome. And I guess this rolls into our third and final story for the week, Chris. Proptrack put out its forecasts for 2024. They were generally optimistic, particularly for Perth, 5 to 8% growth forecast, and Brisbane, 3 to 6% forecast, Sydney, 2 to 5%. Less optimistic for Darwin, Canberra and Hobart, and to some degree Melbourne. Actually, Adelaide, 4 to 7% as well. I think, though, some of these forecasts, and I saw some more bearish ones out from various other data providers, but I think actually even since they were pieced together, we've just seen such a huge rally in the bond market that the outlook has changed. I think the fear factor about interest rates is evaporating, and I think we're going into a shutdown period now, probably for the next 5 weeks, where not really much is going to be listed. There'll be very few auctions happening, the festive period. I think over that time we're going to start to see a build up in demand. And the market's probably going to hit the ground running in February. And I think actually some of the sort of negative forecasts, I'm just looking at the ANZ put out a graph, population increase running at about 175,000 plus a quarter, and dwelling completions 40. It's absolutely a massive mismatch between supply and demand. So interest rates were the one negative factor previously, but that even that hasn't really stopped the market. So I don't see how you get to a negative outcome for 2024 based on those fundamentals, I guess.
So I think coming into 24, people are going to be surprised that listings are just going to stay tight. Maybe not in the apartment market where a lot of investors are bailing. Maybe investors are going to bail out of their houses as well when, the cash flow is still really tight and their current mortgage is, they're just running out of cash. They're going to sell their houses and if they've got investment properties. But I think listings are going to stay, unfortunately quite low until borrowing capacities come back and prices start really jumping again. That will allow people to enter the market. And so listings are going to be a bit of a lag. And I think demand's going to still be there, particularly, in a rental crisis and people entering the market over the next 5 years. We usually find that the market surprises people in February, how strong it comes back. And I would say, just looking at our inquiry and the people coming to us, I think there's enough buyers there and enough buyers entering that are going to offset whatever supply does come on in January and February. And all of a sudden people can be surprised. They start to say, oh, actually, I thought that would sell for $1 million and it sold for, 1.1. Or even they thought the apartment happened to us on the weekend. The client was trying to buy a cracking little apartment in the inner west, thought it would probably go for high sixes, maybe up to low sevens, and ended up going for 770 or something, way over what it was probably worth compared to some past sales in the last 12 months in the building. And so, I think we could easily be surprised. I think go back to, I think it was 2020, that Feb time came back really, really strong, or maybe it was 2021. People got really surprised the amount of demand in supply seesaw that really flipped to a really strong market in the space of 5 weeks, particularly if that bond story goes another level. It's moved from 4.2 or something like that down to 3.6. So 50 basis points drop in a month is quite big. If that happened again, that would give people a lot of confidence. Consumer confidence would jump up a lot if they believe that rates are going to get cut dramatically over the next couple of years.
Yeah, of course, that might point to a harder landing than expected for the labour market, but we'll have to wait and see how that plays out. So it's been a pretty cool year for the Australian Property Podcast. We wanted to, by the end of the year, get to 25,000 unique listers each month, and we've blasted past it. So our target for 2023 was easily overcome. So happy days, and we're looking forward to doing more of the same in 2024. So just to wrap on this week, working from home, still pretty popular, less so than it was in 2021. And some people are back in the office 3 days. Home ownership rates trending down over time, maybe an impact for the retirement system, and some food for thought there about reverse mortgages and whether or not to take debt into retirement, and some generally pretty optimistic forecasts for 2024. I guess 2023 really did surprise to the upside. I think if you went back to the start of the year, there was some pretty bearish narratives out there that didn't really play out. So do send us your questions in via the link in the show notes so we know what to cover as the next few weeks roll on through January. And if you want to catch Chris over at Blusk, he's always happy to have a chat. And you can catch me on my daily blog, Pete Wargent Blogspot, or at Pete Wargent on Twitter. So I think that's a wrap for this Christmas episode, Chris. Any plans for Christmas Day?
Yeah, we've got our family coming to our place, which is, I don't think it's looking at the greatest of weather, which is we've had some stinkers the last few weeks. And then we're off to Thailand on the 27th for a few weeks. So we're not doing any more 2 cents, unless you're going to do something with Owen. I'm not sure if you are. But I think we're doing ones together, Pete, from about the 28th of Jan will be our next episode together. So it's going to be interesting to see how much.
Yeah, we've got some other good. We've got some really good episodes coming out on some different topics in the meantime until we hit the ground with 2 cents again in the new year. So, Chris, it's been a pleasure. I've really enjoyed our weekly chats. And Merry Christmas, everyone. And Chris, have a great time in Thailand. And we'll look forward to seeing you tanned and renewed in the new year.
Merry Christmas. Let's see how this tan goes with an English white skin.
Good luck. Cheers.
Thanks. Bye.